Hello and welcome back to Money Moves Daily, your London briefing. It's Wednesday, September 3rd, 2025. I'm Sophia Reyes.
And I'm Jason Miller. Sophia, it feels like we're constantly on a roller coaster, and today the market's definitely tilting downwards. The FTSE 100 closed lower yesterday, and there's a real buzz of concern around government borrowing costs. Are we back to square one after all those rate cuts?
It certainly feels that way, Jason. The big story hitting the headlines is the surge in UK government borrowing costs, with long-dated gilts hitting highs we haven't seen in over 27 years. That's a huge red flag, and it's putting immense pressure on the Chancellor ahead of the autumn budget. We'll be breaking down what this means for the economy and your finances.
Plus, we'll be looking at why inflation just won't seem to quit, even after the Bank of England's efforts. My shopping bill still feels like it's going up, not down. And in our quick hits, we'll dive into some specific company news and a cyber incident that's making waves.
And finally, in What to Watch, we'll preview some crucial economic data due out tomorrow that could really set the tone for the rest of the week. So let's get into the deep dive. All right, Jason, let's tackle the elephant in the room, UK government bonds. On Tuesday, the yield on the 30-year gilt spiked to its highest level since 1998. This isn't just a technical market detail, it's a direct indicator of how much the government has to pay to borrow money, and right now, it's getting more expensive. It signals investor nervousness, both globally with the decline in government bonds and specifically domestically regarding the UK's fiscal position, particularly as the Chancellor scrambles to find savings or raise taxes to plug a significant budget hole.
Okay, so if the government has to pay more to borrow, does that just mean we, the taxpayers, ultimately foot the bill? And what about our mortgages? I know the Bank of England cut rates to 4.0% just last month, but if borrowing costs are going up for the government, how long before that hits homeowners looking to remortgage again?
Precisely, Jason. Higher gilt yields can indeed translate into higher long-term interest rates across the economy, including fixed-rate mortgages. It tightens the government's fiscal headroom, potentially leading to tough choices on public spending or further tax increases down the line. It's a clear signal from the markets that they want to see a credible plan for fiscal sustainability, especially with an autumn budget on the horizon. The Bank of England has been trying to ease monetary policy, but this market reaction adds another layer of complexity to their balancing act.
Speaking of balancing acts, let's talk about inflation. It feels like the Bank of England cuts rates, then we hear inflation's still sticky. The latest figures show CPI inflation rose to 3.8% in July, up from 3.6% in June. What gives? Are we ever going to get back to that 2% target, or are we stuck in this higher for longer world?
You're not wrong to feel that way, Jason. While inflation has moderated significantly from its peak, the July figure of 3.8% is still stubbornly above the Bank of England's 2% target. This stickiness is partly fueled by a robust labor market. We saw 239,000 new jobs created in the second quarter of 2025, and average wages, excluding bonuses, rose by 5.0% year-on-year. Strong wage growth, while good for individual pockets, can create upward pressure on prices, making the fight against inflation more protracted. The MPC did cut rates to 4.0% in August with a slim majority, but these inflation and employment figures are certainly making the pace of further cuts more uncertain.
So strong employment and wage growth are now a problem for getting inflation down. It's a catch-22 for regular families.
It certainly presents a challenge for policymakers. They want to avoid a recession, but they also need to get inflation under control. It's a very fine line to walk.
All right, let's quickly shift gears to some other headlines making noise. What else should our listeners know?
First up, the wider market reaction to those rising gilt yields wasn't pretty. London stocks closed lower yesterday, with the FTSE 100 down about 0.4% and the FTSE 200 shedding nearly 2%.
Ouch. Any specific sectors taking a hit, Sophia?
Indeed, banks like NatWest, Lloyds, and Barclays were among the top fallers in the FTSE 100. This isn't surprising, as rising borrowing costs impact their profitability and loan books. On the other hand, gold miner Fresnillo shined brightly, typically a sign of investors seeking safe haven assets in uncertain times.
Interesting. And finally, something a bit different for our tech-savvy listeners.
Yes, Jaguar Land Rover has confirmed it experienced a cyber incident, though details are still emerging. It's a reminder of the constant vigilance required in our increasingly digital world.
Thanks, Sophia. Now, looking ahead to the next 24 to 48 hours, what should we be keeping a close eye on?
Forward-looking tomorrow, Thursday, September 4th, we're expecting the UK's preliminary Q2 gross domestic product GDP data alongside June factory data. This will give us a fresh snapshot of economic growth and manufacturing output, providing crucial context for the Bank of England's future decisions on interest rates and the government's fiscal strategy.
And for us, the everyday listener, what could those numbers tell us? If GDP is stronger, does that mean more rate cuts are off the table?
A stronger than expected GDP print might lead the Bank of England to maintain its cautious stance, potentially pushing back expectations for further rate cuts, as it could signal continued underlying economic resilience despite inflation pressures. Conversely, a weaker reading could strengthen the argument for more aggressive monetary easing. It really is a key piece of the puzzle, influencing everything from the pound's value to overall market sentiment.
So tomorrow's data release could be a significant market mover. Thanks, Sophia, for that essential heads up.
You're welcome, Jason. So to recap, we're seeing UK borrowing costs surge to multi-decade highs, driven by market jitters and fiscal concerns. Inflation remains stubbornly elevated, supported by a strong jobs market, which is complicating the Bank of England's path for future rate cuts. And we're all watching tomorrow's GDP data for clearer signs on the UK economy's health.
A lot to digest, as always. For more in-depth analysis and to stay on top of all the breaking news from the City of London, make sure you subscribe to Money Moves Daily wherever you get your podcasts.
We'll be back tomorrow with all the latest. Until then, stay informed and make smart money moves.